Hello and welcome to CN Professional Institute. We are still on IAS 19 employee benefits. In the previous video, we looked at the defined benefit plan, and then we looked at the defined benefit obligation and the defined benefit of asset, all under the defined benefit plan, right? So we solved one question where we separated the defined benefit obligation from the defined benefit asset, right? Now, let's continue. In this video, we are going to continue with the defined benefit plan. Then we look at the components, okay? We look at curtailment, amendments, and then stuff. So let's start with the defined benefit plan movement. Let's look at the net. This time, we are not going to do the asset separately from the liability. We are going to look at the net, but it's the same, okay? It's the same thing. Now, look at this. So here we bring the defined benefit obligation, defined benefit assets, and we have what? The net, right? We bring the opening balance as we did with both the asset and then the liability when we're doing it separately, one by one, right? We brought the opening balance here. So the obligation is the same thing. You bring the opening balance, okay? Then we computed the interest income, which is normally the rate, okay, the interest rate on the opening, and we got the interest income. And I said there are other cases where it will not be only on the opening, okay, but we'll look at those ones later. So we brought the interest income here, which is said is the rate, the interest rate on the opening balance, and that will give us the interest cost. Okay, we are doing liability here. What we are doing is defined benefit obligation. Okay, so when you apply the interest rate on the opening balance, you get interest cost. Okay, you get interest cost. We are looking at only the obligation. So when you bring or when you multiply the interest rate, if you multiply the interest rate on um the opening liability, you get interest what cost. Then we said we'll add service cost, contribution to the plan. Does it affect obligation? We don't contribute into the obligation plan. Okay, we contribute into the asset, the defined benefit what asset. So the contribution to the plan does not affect the obligation. It doesn't affect the defined benefit obligation. It affects only the defined benefit assets. So we bring that's why we brought it here. Benefit paid affects both the liability and the asset. Okay, so when you pay into the plan, we said I'm sorry, when you pay benefit, when you pay benefit out, I mean benefit paid out, we said we pick the amount from the defined benefit asset to go and pay the obligation. I mean to go and pay the employees their benefits. So when you pay, we take money from the asset, and that reduces the asset. And then the obligation too, because we are paying, okay, we are paying their retirement benefits, okay, the liability reduces, the obligation associated with the fund, okay, reduces. So benefit paid reduces both the liability and the asset. That's why it has no net impact. Then we do array measurement, okay. So that's the same thing here. When it comes to the asset, it's the same thing. You bring the opening asset, then you apply the rate on the opening balance, and that gives you interest income. This liability, so it gives you interest of income. Service cost doesn't affect the asset, it affects only what? The obligation. Okay. And then the contribution paid into the fund too. The contribution paid into the fund or into the plan also does not affect the obligation. It affects only asset. That's why it's another asset. And we said benefit paid out affect both asset and what? The liability. So that's it. Now, when it comes to the net side, the net will be the defined benefit obligation minus the defined benefit asset, and then bring the net here. You see, if the obligation is more than the asset, the net will be a liability. I hope it's clear. So normally the order is not that important. You should know what you should know is that if the liability is more than the asset, the net will be what? A liability. And if the asset is rather more than the liability, the net will be an asset. That's what you have to have in mind. When it comes to the interest side too, you see, if you go to liability, this is interest expense, this is interest income. You find their net and you bring it here. So if the interest cost is more than the interest income, the net will be interest cost and vice versa. Are you following? So that's it. Then here, the service cost, the asset has no service cost. So it will be this one minus dash, and then this here. That's what we have it here. Then contribution to the plan. We said obligation here has no, the defined benefit obligation has no um contribution to the plan. Contribution into the plan doesn't affect the liability. That's why here is dash. It affects the asset. So this minus this. That's why it's in bracket here. Okay, we'll work this out with figures and you really understand. So normally we do it the obligation minus the asset. It can be done the asset minus obligation. It doesn't matter. But usually with the defined benefit plan, in most cases the obligation is more than the asset. It's normally in few cases where the asset is more than the obligation and we have to do asset selling. But in most cases, the liability is more than the asset. Okay. So the net is mainly liability. But you could see cases where the net is what asset. Okay. So this one contributes to the plan, this one here minus this one, and we have this. That's why it's in bracket. Benefit paid out here, the same here, the same here. So it doesn't affect the net. So be very careful. We'll solve questions involving only the net. You will not have the obligation, you will not have the asset, but you will be given only the net. Contribution paid doesn't affect the net. And you know why? It affects both obligation and liability, and it affects both obligation and the asset. It affects both obligation and the asset. So when you find the difference, the net will be zero. Okay, so that's why benefit paid does not affect or has no impact on the defined benefit what plan. Then we do our remeasurement. Okay, we compare the closing balances with the expected values we've gotten, and the difference becomes the remeasurement loss or gain. These differences here, they're the remeasurement loss or what gain. I think we tried one in the previous video where we solved one question, right? Okay, so that's how it is. Or you can do it this way. When you come here, the interest income here, okay, what you do is you don't find the interest cost. Okay, when you come to this side here, I mean the interest side here, whether it's interest income or interest cost, the net. Now you can decide not to find the interest cost, find the interest income, and then come and find the difference. You can decide to apply the rate, the interest rate on this opening balance. So you see, if the opening balance is an obligation, is net obligation, and you apply the interest rate on it, what you get is you get interest cost. If this opening balance here is a net asset or surplus, if it's a net asset or surplus, and you apply the interest rate given the question, and you apply the interest rate on this net asset or surplus, here what you get here will be net income. It's the same thing. I follow the same thing. So we will look at that more. Okay. And then we'll solve more questions for better understanding. So that's the net and how it works. That's the same thing here. The same thing here. You see here they brought net surplus or deficit here. This is we have net deficit or surplus. Then they brought the figure here. If it is deficit, that is a liability. The net's a liability, and you apply the interest rate on it. That's what I've just said. And you apply the interest rate on it. What you come and get here will be net expense. Okay. If the opening is net asset, that's surplus. If net asset or surplus, and you come and apply the interest rate on it, you come and get net income. Okay, so it's the same thing here. Then the service cost, we said it is added to the net. We saw it here in the next slide. It is added. Okay, if you come here, can you see we added we added here the service cost is added. That's the same thing here. So we add service cost to the net. Contribution to the plan is deducted from the net. Why is it deducted from the net? It depends on what we are doing. That's what I said. It depends on whether the net is a surplus or deficit. But normally we deduct the contribution into the plan because see how we got the net. It is the obligation minus what? The asset. That's what will give you what the net. So obligation is nothing. Asset is something. It's like zero minus a figure. You get negative figure. You get negative something. So if here is zero, The obligation is zero, asset is 50. 0 minus 50 should give us minus 50. That's why normally the contribution to the plan under the net, we did that. Okay, don't worry, we use figures, and we said benefit paid does not affect the net because it reduces both the liability and what the asset, so it doesn't affect the net. That's why here is what dash. So don't forget that if you are doing the net, benefit paid out will never affect the net, and then we do a remeasurement. You add these ones, you get the expected value, come and compare with the closing, and the difference is the remeasurement loss or gain. So this is the net and how it works. Okay, let's go and look at the components. Let's go and look at the components and then a bit of explanations. Okay, so we are going to look at what service cost is. If you want to do debit and credit, it's fine. I will explain that to you. Okay, but I think you have seen what you have to see or you are expected to see, and then you have the format in mind, and then the reason why the figures are so, right? Okay, now let's continue. Let's look at the components of the defined benefit plan. These components, okay, the opening balance, the interest income or interest expense, the service cost, contribution to the plan. Those are the components. Those are the components. So let's look at it. The first one is what? Net interest. So the net interest, we said it will be the interest income against the what? The interest cost. Interest income against interest cost, putting the two together and finding the net. That's it. But let's look at the debit and credit side. Okay. So let's start with the interest cost under the defined benefit what? Obligation. So with the interest cost, how do we treat it? Okay. With the interest cost, if you remember, we add it to the obligation. Okay. We said when we compute the rate on the opening balance to get the interest cost here, we add it to what? The defined benefit what? Obligation. And we also go and record it in the P&L. When we print the extract, we said interest cost will go to where? P&L as an expense. It's the same thing. So what are we doing? We are debiting P&L and we are crediting what? Defined benefit obligation to add. Are you following? So with only the um with only the defined benefit obligation, or with the net, sorry, not the net, with the interest cost or the interest expense, okay, what did we do? We said we normally debit what? P&L. Are you following? So we'll debit our P&L to add to the expenses, and then we will credit what? Our defined benefit obligation. That's how we treat the interest cost. The interest cost. Okay. Then with the interest income, when it comes to under the asset, interest income too, we say we add to the opening what? Asset. Okay. So when you apply the rate on the opening asset and you get your interest income, we add it to what? The asset, the plan asset. I follow it to increase it. So with the interest income, okay, how do we do that one? With the interest income, we said we normally debit the asset to define, we debit what? The defined benefit what? Asset to add up. And then we take it to what? P&L as an income. So we credit what? P&L. That is the debit and the credit entry for the interest income. So when you compute your interest income, we said here you add it to the asset. So you go and debit the asset, the defined benefit asset, and you go and credit P&L, because when we're doing the extract, the interest income, we take it to what? P and L as an income. So that's the entry. If you come to the net here, the net depends. It depends on whether it is net liability or net asset. If it is net asset, it's the same treatment. You debit the asset. Are you following? And you credit income. Are you getting it? So if the net is an asset, they will treat it the same way as an asset. With that net interest, we'll debit asset and we'll credit P&L. Are you following? If it is net obligation, if it is net obligation, okay, or deficit, we treat the same way as the obligation. In that case, we'll debit P&L and we'll credit what? Our defined benefit obligation. Okay, so the net method depends, the net method, it depends on whether your net is obligation or is an what? An asset, right? So I'm saying again that if the net is obligation, it's the same as what? The liability. So what do? You will debit your P&L. That's what we have. This is debit income. This income is what? The P&L, the income account, the P&L account. So if the net is obligation, okay, or deficit, as we normally call it, you debit your P&L and you credit your defined benefit obligation. It's the same as obligation, and it says and vice versa. Vice versa will be if your net is an income. If your net is an income, you treat it. I say if the net is an income, okay, that's your net interest is an income. You treat it the same way as you treat the income. I following? Uh, you debit the asset to add up because you got net income, which means that your income was more than what? Your expense, meaning that your asset was more than your what? Your liability. So you had net interest income. So we said with that income, with that net interest income, because this income, we add it to the asset. So we debit the asset, okay? We'll debit the asset and we'll credit P and L. So this is how we treat the income itself. That's the interest income, interest cost, and the net. So the net would depend on whether it is net expense or net what? Income. And the treatment, if it is net income, you treat it the same way as the income. If it is net expense, you treat it the same way as what? The what? Expense. Are you following? So that is it. Then we have some more questions to really so that you get it. But it's the same thing. What we've done here, the addition and subtraction, the same thing we are doing here. Okay. I'm just by here we are just using debit and credit. It's the same thing. Then we have what we call the service cost or the service component. Here we said the service cost here in the format with the our service what cost, and we said it affect only the obligation. Are you following? So I'll come and explain the components. But if we say service cost affect only the obligation and we add to the obligation, then we take it to P&L as an expense. That's how we did it when we're doing the extract. Okay. So we added it to the defined benefit obligation and we took it to P&L as an expense. It's the same thing. So if you are adding to your defined benefit obligation, what do? You would debit. Are you following? So meaning that with the service cost, we are adding it to the obligation. Okay. So we'll debit what and we'll credit what. You see, we are adding it to obligation, and the obligation is a liability. So if you're adding to the liability, you have to credit the defined benefit what? Obligation. So we'll credit defined benefit what? Obligation. So that we can add the service to the defined benefit obligation as we have in the format, right? The service cost is added to defined benefit what? Obligation. So we have to credit the defined benefit obligation, which is the liability, to add up. And we said we'll treat it in the P&L. So we'll debit P&L. When we're paying the extract, remember that we took the service cost to what? P&L when we're doing the extract. Okay, so we take it to P&L as an what? Expense. So you debit P&L and you credit your defined benefit obligation. So basically that's it. We'll come and look at what is inside the service cost. The service cost has three components. We have the current service cost, the past service cost, which has both the amendment and then what? Curtailment. We'll explain these terms and I'll use examples to illustrate. Right, by now we are looking at the debit and credit, so we'll get back to that. And then we also have gain or loss on what? Settlement. How do you treat it? So we'll come back and look at that. So we have them here. Then let's go and look at the contribution to the plan. What's the debit and credit? Contribution into the plan. So let's go up here. When we come here, contribution to the plan, we said it doesn't affect the obligation. It only affects what? The assets, because we are adding more money into the plan assets. So it affects the asset and then the net. So you see, when you look at the asset, okay, we said we add a contribution to the asset. If you add a contribution into the asset, you are debiting what? The asset. Are you following? And you are putting money into the asset. So you debit your asset, your defined benefit asset, and you credit your cash. So that's how we treat the payment into or contribution to the plan. Okay, so you debit your here, you debit your defined benefit asset and you credit your cash or your bank. You are just paying into the plan. And we said this one has no impact on the liability. It doesn't affect the defined benefit obligation, it affects only the defined benefit asset. Okay, then we have payment into the plan. Benefit sorry, not payment to the plan, sorry. Here we have benefits paid out. Let's see the double entry. Let's go back here. We understand if you come to benefits paid out, we said it reduces both the obligation and the asset. So the impact is net. So it reduces the defined benefit obligation. So if you want to reduce your liability, what do? You debit it. Liability has a credit balance. So if you want to if you want to reduce it, you debit it. Asset has a debit balance. If you want to reduce it, you credit it. At all. Asset has a debit balance. So if you want to reduce it, you credit it. So with the benefit paid, we'll debit the obligation and then we'll credit the asset. So that's what we have here. We'll debit the obligation to reduce the obligation and we'll credit the asset to also reduce what? The asset. And it a reduction in both asset and what? Liability. And then we said the remeasurement components, we take them to OCI and they are not reclassified. Okay, so the benefit paid out, he said amount paid to what? Retired employees. So the amount you're paying to the retired employees. And we said we'll take it from both, oh, sorry, we'll take it from the asset and we'll come and pay the retired employees. So it will reduce the asset and it will also reduce our liability because the more employees you pay, your obligation reduces. Okay, if you have 20 people covered by your scheme and you pay 40 people, you pay 4 people, you have 20 people covered by the scheme and you pay 4 people, it is going to reduce your liability as well. And we said we picked money from the assets, so the asset was what reduced. And it says there's no impact on the statement of other comprehensive income. And it also has no impact on the P&L as well. Right. So these are the components. Okay, so let's continue with the service cost. We looked at the other components and then there are double entries. Right. What we debit, what we credit. Right. Let's look at the service cost, okay, or the service component. Now we said the service component has three components, right? So when we pick the service cost, it has three components. We have the first one to be the current service cost, the past service cost, and we have what we call loss or gain on settlement, right? So the service cost has three components. The first one is what? The current service cost. Then we have the past service cost, which includes amendments or curtailment or amendment and curtailment, right? So we have the current service cost, the past service cost, and loss or gain on settlement, right? And we looked at the double entry. We said service cost increases the defined benefit obligation. If you look at the table, right? If you are doing the obligation, you bring the opening balance of the obligation, then you add the interest to it, and you add service cost. So service cost increases what? The defined benefit obligation. That's why we credit the obligation. Obligation has a credit balance, right? So we have to credit the defined benefit obligation. We have to credit it to increase it. We have to debit the P&L. This debit income here is a debit to what? P&L. That's with the current service cost and then the past service cost. The loss or gain on settlement depends. If it is a loss, okay, if it is a loss, we add it to the service cost, meaning we debit P&L. But if it's a gain, we less it, or the gain should reduce the service cost. Okay, so a gain on settlement should reduce the service cost. Meaning if it's a gain, we have to do or deduct from the service cost, meaning we have to credit, we have to credit, we have to credit our P&L. Okay. So again is added to, sorry, a loss is rather added to service cost, meaning it is debited to P&L, and the gain is deducted from service cost, meaning a gain on settlement is credited to P and L. We use it to reduce the service cost. We will look at it. Let's pick the components one by one now. Let's pick the component of the service cost, right? So in this video, we'll be looking at more of what the service cost, and then we will solve um one question on amendment or curtailment, and then we will look at the other components, right? So let's pick current service cost. Current service cost, right? It says current service cost is the increase in the present value of obligation arising from employee service in the current period. The increase in the present value of obligation arising from employee service in the current period, right? So it arises when employees render service in the current period. Now, what do we mean? You see, as employees work, okay, for the year, their benefit entitlement increases. Are you getting it? Resulting in a higher defined benefit obligation. So as they work, their entitlement increases as they work for a particular year, as they work for one more year, right? They expect the entity to pay their Senate contribution, to pay their social security contribution, and that is expected to increase the future benefit they will get. Okay, so the more they work, the more payment is made into their Senate, into their plan asset, into their fund for them. Okay, the more contribution is made into their social security plan, and that's expected to increase the amount they'll be receiving in the future. Okay, so current service cost arises when employees work in the current year, and that's expected to increase their benefit in the future. That's expected to increase the amount of Senate or the amount of pension contribution or pension amount, the pension amount they'll be receiving in the future. It's expected to increase because the more they work, they expect that to increase, right? So that's current service cost is the increase in the present value of the obligation, okay, arising from the employees working or rendering service in the current period. And we said that's expected to what increase their entitlement because the more they work, the more contribution is expected to be made into their fund or into their Senate contribution, which in turn is expected to increase the benefit they'll be receiving in the future when they go on retirement, right? So that is the current service cost. The past service cost is the change in the present value of obligation for employees, right? Or the change in the present value of obligation for employee service in the prior periods resulting from plan amendment or curtailment. So it says, as the name implies, the current service cost is what the increase there in their liability or the increase in the PV, okay, the obligation for the entity as employees work more in the current year. With the past service cost, it says the obligation is as a result of what the past event or it's from what the prior periods, the earlier periods, okay, the previous periods, okay. So it's the change or the increase or decrease. That's the change in the obligation, okay. That the entity is expected to settle in the future as a result of what prior periods or from the beginning years or from the earlier years. And it says past service cost is from two main things, from plan amendment or what curtailment. So these are the two main elements of the past service cost: plan amendment and or plan curtailment. So amendment and what curtailment, right? So these are the elements of the service cost, the past service cost. So these are the elements of the past service cost, right? Now we will look at them in detail. We look at amendment and what curtailment. We look at them, right? It says past service costs arise when there has been improvement in the benefit to be provided under the plan or when there has been curtailment. So we said with the past service costs as a result of amendment or curtailment. An amendment, okay, is a change in the benefit provided under a plan, either an increase or what decrease, right? So let's look at what amendment and curtailment are. Let's look at what amendment and curtailment are. So it says here amendment occurs when an entity introduces, withdraws a defined benefit plan or changes the benefit payable under the existing defined benefit plan. So it says amendment happens when the entity was introduces, that's introduction, withdraws, right? or changes the benefit that is paid or payable under an existing plan. So the plan is already there. Okay, it's already what there, but the benefit has been changed, either increase or what decrease. So amendment can either result, it can either result in what the entity providing additional benefit, that the increase in benefit, or a reduction in what benefit. So it can happen. Okay, now look at plan amendment. We said amendment happens either when there's introduction, withdrawal, or change in the benefit payable, right? So let's look at this. Let's say the rate of contribution into the fund, into the plan asset has changed, right? So let's say in Ghana here, let's say the let's say the 5.5% of the base salary, and then the 13% also of the base salary that are made into the plan. Okay, now let's say this amount change, this rate change, and therefore a higher contribution or a higher amount is paid into the plan. You see, when higher amount or greater amount of money is paid into the plan, into an existing plan, right? We expect the benefit payable in the future to increase because you are making more payment into the plan. And when more payments are made into the plan, the employees are entitled to greater amount in the future when they go on what retirement. So you could see that this type of amendment has brought about an increase in benefit payable to what organization. So when let's say the rate of computing or let's say the payment into the plan, okay, has increased, or the contribution into the plan has increased on behalf of what the employees, this will result in what an upward amendment. It will increase the benefit, and when the benefits are benefit payable to employees, when they are increased, it becomes extra expense to what the entity. So be very careful. If there's an amendment that will increase the benefit that is paid to employees, that type of increase or that kind of increase, that kind of amendment is expected to what increase the obligation. I following, because in the future you'll be paying more. You'll be paying more of the what of the destinate contribution, or sorry, in the future you'll be paying more to the employees. I following. So the manager of the fund in the future is expected to pay more. I following, is expected, or the entity is expected to pay more into is expected to pay more money toward the employees when they go on retirement. So an amendment that will increase the benefit payable to an employees is expected to increase the obligation, right? That's why when there's amendment, and the amendment will provide or increase benefit payable to employees, it increases the obligation, or it increases the service cost. On the other hand, when the amendment will reduce the benefit payable to an employees, right? When an existing plan will reduce the benefit payable to employees, that's expected to reduce our what? Our obligation, which in a way will reduce the service cost as well, right? So that's amendment. It happens when the entity that introduces, withdraws, or changes the benefit payable under an existing what plan, right? But mainly or basically, amendment happens when there has been improvement in the benefit paid or payable to employees under an existing plan, because normally plans are amended upward to provide additional benefit to employees, and that will result in extra obligation by the entity. Good. Then we have what we call the curtailment. Curtailment occurs when an entity significantly reduces the number of employees covered by the plan. So curtailment is the reduction in the number of employees covered by a plan or on the plan, right? So let's say an entity has 20 employees on this plan, and then something happened because of redundancy, because of closure of part of the organization. The number has reduced to four. Four people have been laid off, and therefore the number has reduced from what 20 to four. So there, sorry, the number has reduced from now 20 to what 16 before, because we said four people have been one laid off. So the number of people have now reduced from what 20 to what four. Sorry, 20 to um 16 because of the layout. Now we said that curtailment, okay, is a reduction in the number of people covered by the plan. That's all. Good. And we said that curtailment, okay, may arise from an isolated what event, such as closing a plant, discontinuance of an operation or termination, or let's say redundancy, reorganization, change from defined benefit to defined contribution, or suspension of what? A plan. So these things here are some of the actions, the activities that can what? Bring about curtailment. These are the things that can make the number of employees what? Reduce. Are you following? Huh. So that's what? Curtailment. Curtailment. So we said curtailment is basically the reduction in the number of employees covered by the plan. Number of employees covered by the plan, right? And these are the activities that can reduce, that can cause the reduction in the number of employees that are covered by a plan, right? Redundancy is one of the most common. Okay, employees can be made redundant, or some can be fired, or their appointment can be terminated, and therefore they might move to different organizations. When that happens, they are moving from the entity's scheme, from the entity's asset to a different entity's what pension scheme. So they can move from the old employer's scheme or pension plan to the plan of a new entity, right? So curtailment can reduce the number of employees. Let's continue and look at what we have here. So here it says curtailment could be with or without what? Settlement. Curtailment could be with or without what? Settlement. So now you are reducing the number of employees covered by your plan, either by termination or redundancy. You are firing them, or there's been a closure of a business, and therefore they are moving elsewhere. Either they are moving to a new company or new entity, or I mean they are just leaving your place for good, right? So it says curtailment could be with or without what? Settlement. Curtailment could be with or without what? Settlement. What do we mean by curtailment with settlement? Okay, so it says an example where there is a closure of a segment of an entity and employees are relocated or have moved to a different what entity. If their plan asset has transferred from that plan to what? A pension plan of the new employer, there's settlement. So what you're saying, okay, when there's a closure of an entity, or when there's redundancy, or there's termination of what? Appointment or contract, and these employees are moving to a new organization, they are moved to a new organization, or they are moving on to a new pension plan, okay, or they are moving to a pension plan of the new entity, of the new employer. If you are going to transfer their asset means the amount of money you've accumulated for them as their pension benefit, or the amount of money you've set aside in their plan that when they go on retirement, you used to pay them. If you have transferred that money, that asset, to the asset of the new employer, then it says there's what? Settlement. Because they are moving from your entity and you are giving them their money that you have accumulated for them. You are giving them, or you are transferring their pension asset to the plan of the new employer. It says if that happens, then you are settling them, the settlement. I get in it. Sometimes you can terminate them, or their contract can be terminated, or they can be made redundant, or they can move to a new company to go and work. But their asset will still be with you. The amount of money in the pension plan that you've accumulated for them, so that they will benefit in the future, will still be with the entity. If that's the case, then there's no settlement, right? So we said curtailment to settlement occurs when, as the employees are moving to a new job, or they are made redundant, you pay them, or you transfer their asset, their money, to wherever they're going, to their new plan, or into the pension plan of the what? The new employer, right? So that's what curtailment with what? Settlement, right? And this is how do we get a profit or loss on what? Settlement. This is profit or loss on settlement will be the difference between the fair value of the plan asset paid out and the reduction in the present value of the defined benefit obligation. So how do we get the loss or gain on settlement? Now they are moving to a new scheme provided by a new employer, and you are also transferring their funds to the new scheme. How do you get the loss? It says you should compare the asset, okay, the fair value of the plan asset that you are paying out, the amount of money that you are transferring toward the new scheme, and the reduction in your what your defined benefit obligation. Okay, so let's say you paid them as they are moving, you transfer the amount of what 9 million to a new scheme, to the new scheme of the employer, or the new scheme provided by the new employer. You are paying them asset of 9 million, and your asset by your asset, I'm sorry, your liability has reduced by 5 million. You see, if there's something like this, there's a loss because you are paying them 9 million. This amount of money you are transferring into what the pension plan provided by the new employer. You are transferring 9 million from your asset to the new pension plan. But your liability is reducing by only what 5 million. So you could say you are paying them more than your liability is reducing. So here there's a loss on settlement. I following. On the other hand, let's say you are transferring 10 million into their pension plan or into the pension plan of the new employer when they are leaving the entity. You are transferring 10 million to the new pension plan, right? But your liability will reduce. So you are transferring what 10 million, but your liability will reduce by what 15 million. In this case, there's a gain because your asset, okay, the asset is reduced by only what 9 million. Sorry, 10 million. Your asset is reduced by 10 million. You are paying them 10 million. So your asset will reduce by 10 million, but your liability is reducing by what 15 million. So the liability is reducing more than the asset. And we say when that happens, there's a gain because we know that when liability reduces more and more and more, it's a gain. So a reduction in liability more is a gain, right? So when the asset you are paying them is less than what the reduction in their liability, then there's a gain and vice versa, right? And it says the loss, if it's a loss, it's added to service cost once a gain is deducted. So if there's a loss on settlement, this will be added to service cost because we know curtailment is part of what service cost. So a loss is added to service cost, and then again, it's used to reduce what the service cost, right? So again, should be used to reduce the service cost, which means it should be used to reduce and it should be used to reduce the service cost or deducted from what service cost. And then we have curtailment without settlement. So as I've explained, when employees are made redundant or they move to a different company or entity and their plan assets still remain with the previous entity without their asset being transferred to the new entity, then it is called curtailment without settlement. Curtailment without settlement. They are moving from your entity or they are made redundant or you are firing them, they're moving from your entity to a new entity, but their asset, the amount of money you've accumulated on their behalf still remain with the entity. It still remain in the assets plan and in the entity's what asset, right? The amount of money you've accumulated for them still remain with the entity. You are not settling them, you are not paying or you are not transferring the assets to their new entity scheme or into the pension plan of the new entity. So we said when that happens, then there's something called or what we call curtailment without settlement. You are not paying them, or you are not transferring the assets to the new entity. So we call it curtailment without settlement, right? Then the last part is loss or gain on settlement. That's the last component of what the service cost. We look at the current service cost, the past service cost, and then we are looking at gain or loss on settlement. We've done this already, but let's look at it. It says a settlement occurs when an entity enters into a transaction to eliminate the obligation for part or all of the benefit under a plan. So it's an agreement or transaction to eliminate all or part of the obligation, right, of the benefit under a plan. So this is what it means. This is what it means. You see, if an employer is leaving a scheme, sorry, an employee is leaving a scheme, or it's made redundant, or is moving to a new organization or new work or new job, right? And you try to pay or transfer their plan asset to the assets or into the scheme of a new employer. You transfer their asset into the pension plan of a new employer. In that case, you are settling them. You are eliminating the obligation. So once you are done paying, if you should transfer all the assets you've accumulated for them to the pension plan of the new employer, you've eliminated all the obligations. So there's nothing with you again, right? So when they go on retirement, they will not come to you, they'll go to a new entity. So you've transferred their asset, their plan asset that you've accumulated for them to what? The pension plan of the new entity or of the new employer. So you have eliminated all the obligation. That's what called settlement. Sometimes you can transfer only part of it, not all. Some will be left, some of the assets will be left under in your plan, in your pension plan, right? If that happens, then we say it is what part. You are eliminating part of the obligation. You are eliminating part, right, of the obligation. Are you getting it? The benefit, you are eliminating part, not all. So we said settlement happens when the entity tries to eliminate the obligation for all or part of the benefit, right? So when you are trying to settle them, you are eliminating the benefits. So that, sorry, if you are settling them, you are eliminating the obligation of the benefit, so that one day they will not come to you again. You are eliminating the obligation, right? So it says, for example, an employee may leave the entity for a new job elsewhere. We've talked about this, and a payment is made from that pension plan to the pension plan operated by a new employer. Okay, the gain or loss on settlement is the difference between the fair value of the plan asset paid out and the reduction in the present value of the defined benefit obligation. So I've talked about this as the loss or gain on what settlement, right? So he said when employees leave the entity for a new job elsewhere and the payment is made from the pension plan by the old employer to the new pension plan of what the new employer, you are doing what we call settlement. You are eliminating the obligation, so that one day when they go on retirement, they don't come to you, they go to what? The new employer. So you are trying to eliminate the obligation of the benefit that you have to pay to them. You are trying to eliminate that what obligation. So we see this, what that's what we call what? Settlement. Okay, we call it settlement. You're trying to eliminate either all or part, right? And it says a gain or loss. A gain or loss form part of what? The service cost. So a gain on settlement or loss on settlement will form part of the service cost. We said if it's a gain, it should be used to reduce the service cost, or specifically the past service cost, because we know curtailment and settlement, they are all part of the past service cost. So a loss should be added to the service cost or the past service cost, and then the gain should be used to reduce the service cost, meaning it should be less from the service cost. Now let's try question 2. Okay, so let's try question 2. Question 2. It says Bright decides to close a business segment. So as they're saying close, some might be made redundant, and then curtailment is likely to happen. The segment employees will be made redundant and will earn no further pension benefits after being made redundant. Their planned assets will remain in the same, and sorry, remain in the scheme, so that the employees will be paid a pension when they reach retirement age. And say this is curtailment without settlement. Then you should know, I've explained already. Immediately, their planned asset will remain with the entity. It will not be given to them, or it will not be moved to wherever they are going. It will not be moved to the new pension plan of the new entity they are going. Then it's without settlement. It will remain, their money will remain with the old employer, and it will be paid when they go on retirement. So this is curtailment without settlement. They've not been paid, or their assets have not been transferred. Before the curtailment, the schemes the scheme assets had a fair value of 500,000, and the defined benefit obligation had a present value of what? 600,000. It is estimated that the curtailment will reduce the present value of the future obligation by 10%, which reflect the fact that employees will not benefit from future salary increases, and therefore will be entitled to a smaller pension than previously what estimated. Now it's very simple. Here they said this curtailment without settlement. How do we get the loss or gain? Let's come to the requirement. It says what is the net loss or gain on curtailment, and how would this be stated in the financial statement? Now, how do we get loss or gain on settlement? We said when there's curtailment and the settlement, how do we get the loss or gain? We said you compare the fair value of the plan asset. Okay, the fair value of the asset that you are paying them. The fair value of the asset that is being paid to the reduction in the liability. So you compare the fair value of the asset that's paid, the cash that's paid to them, with the fair value or with the reduction in the obligation. And the two is what the difference is what will give us a loss or gain on settlement, right? So let's look at the reduction in the obligation and then the fair value of asset paid to them. Okay, now let's look at the reduction in obligation. Okay, so the reduction in the liability, we're told that the reduction is 10%. Are you following? So that will be 10% of the liability, because it said we expect the liability to reduce by 10%. So 10% of the obligation, so 10% of 600,000, right, will give us 60,000. So 60,000 is the reduction in what? The liability. 6,000 the reduction in the defined benefit obligation, right? Because the question said they expect the liabilities to reduce by 10%. So the 10%, the 60,000 is the reduction, right? The standard says to get the loss or gain on settlement, we have to compare the reduction in the liability to the asset paid to them. Do you know that here no asset has been paid to them? Yes, they didn't pay them anything, right? They just gave us the fair value of the asset to be 500,000. They didn't pay them anything. They said their asset will remain with the entity, will remain with the scheme. So nothing has been paid out. In the previous as we move on in the future examples, I mean in the question and answer session, or even before that, in the example we'll be solving, we'll solve more where you will see that asset has been paid to them, fair value of asset paid to them, we compare to the reduction in liability, right? But here they didn't pay them anything. There's no reduction, oh sorry, there's no asset paid to them. I following. So in this case, the whole 60,000 become the reduction in the liability, and the reduction in the asset is zero. Okay, so reduction in asset, I'm sorry, not reduction in asset, sorry. So the asset paid to them, asset paid to them, or asset paid is zero. So you realize that they didn't pay them anything. So our asset has not reduced. Our asset is still the same. It will still be what, the 500,000. But our liability has gone down by what? 60,000. Are you getting it? So there's a gain. So this is a gain on settlement or curtailment. So let's say gain on curtailment. And here, this is curtailment without settlement. We said they are not paying them. So we have a gain on curtailment of what? 60,000, right? And you understand why this is a gain. We said because our liability will reduce by 60,000, but our asset will not reduce. Our asset will still be the same. So it's good. Our liability is reducing while our asset is still the same. Our asset is not reducing, but our liability is reducing. So it's a gain. So there'll be a gain of 60,000, right? Which is what? The 60,000 reduction liability minus the zero reduction in asset. So we have a gain on curtailment. How do you treat this gain? We said we have to take this gain to what? P&L to reduce the service cost. So the treatment will be that the gain of 60,000 will be used to reduce the service cost, right? So if there's a service cost in the question, or if there's past service, other past service cost in the question, you have to go and deduct the 60,000 from the past service cost, because the past service cost is an expense. The past service cost is what? It's an expense, or service cost is an expense. So when we make a gain, we use the gain to reduce what? The expense. Okay, so my curtailment, let me spell it well. Okay, curtailment, right? So the 60,000 gain on curtailment will be used to reduce the service cost, or the past service cost will be less from the past service cost, right? And then, so that's the treatment of the financial position. And then now when you go to your financial position, if you are doing the extract, statement of financial position, okay, um, our assets will still be the same. So the defined benefit assets, right, will still be the same 500,000. It has not reduced, but the liability now has reduced. So your defined benefit obligation will be the 600,000 minus the reduced figure minus the 60,000, which will give us 540,000, which is what? 540,000, right? So our defined benefit asset is 500, has not changed. The defined benefit obligation is 540. So if you want to get a net, so here you realize that the net, okay, the net, which is the defined benefit plan, will have a liability, right? A net liability of what? 40, right? So you record the net liability of 40 as your non-current liability. So we are saying that, okay, if you are doing the extract, this gain of 60,000 should be less from the past service cost or the service cost. So it means that we have to we have to our um credit our P&L, because we said that has to reduce the expense. So we credit P&L and we debited the liability. So that will be the entry for the 60,000. You debit your P&L, or you credit P&L, or you credit your service cost with the 60,000, and you come and debit the obligation to reduce it. You see the liability has a credit balance. It was 60,000. Sorry, it was 600,000. Liability has a credit balance. It was 600,000. When we debit it with the 60,000, it will now move to what? 540. So with the 60,000, you debit your liability, your defined benefit obligation, and you credit P&L, right? So this is how it will look like in our books, right? So that's it with this session. We'll continue and look at asset selling. So we have asset selling left. So in the next video, we'll solve one full question, and then we will look at asset selling. Then when we are done, we'll look at the question and answer session where we solve more questions on settlement, amendment, asset selling. And we'll solve complicated questions. I've shown you one question which involves a lot, all elements. We'll solve them, right? So I'll see you in the next video.